Thank you, everyone, for joining us. We're going to get started here just very soon. Give everyone a couple stragglers the ability to get situated. If you want to go get yourself a drink, um, we'll be getting started here in the next couple minutes here. So thank you for joining us. Thank you all for joining us tonight, and welcome to Flagship Financial's annual State of the Markets event. I'm very excited to have everyone joining us tonight for this very special event. Tonight, we have the honor and privilege to be joined by Gene Goldman, Chief Investment Officer of Cetera. By partnering with Gene and the rest of the team here at Cetera, we are able to provide an unparalleled layer of due diligence to our investment research process. Gene is responsible for the strategic direction and continued growth of our firm's research offerings. Gene provides day-to-day oversight over Cetera Investment Management with a focus on providing unbiased research about the economy and financial markets. He also leads the investment committee and their commitment to delivering superior investment oversight. Gene has over 26 years of experience in the development of investment strategies, money manager research, and overseeing investment analysts. Prior to joining Cetera, he served in a variety of roles at LPL Financial, including market strategist, and was the lead strategist of the Manager Strategy Group. Gene is frequently cited in a range of national media outlets, including the Wall Street Journal, Bloomberg News, the New York Times, Forbes, Reuters, and he is a regular guest on high-profile news networks, including CNBC and Fox Business News, and has been a keynote speaker at dozens of industry events. We most recently saw Gene when I was a panelist in Nashville, and he did a keynote event with Matthew McConaughey, which was tremendous. Now, before I turn it over to Gene, I wanted to take some time to highlight some of the great things that we have going on here at Flagship. Last year, our youngest member of the team, Caroline Wozleski, became a registered representative, investment advisor representative, and also a PA, Pennsylvania, life accident and health insurance license producer. She accomplished all of this in 1 year, which is no small task. By passing her Series 7, 66, and insurance exam, she aspires to be a producing advisor in the near future. We're all very excited for Caroline's bright future ahead of her. Joe Lustracco from our office has continued to grow professionally, has started his coursework for the CFP designation, and is currently in the process of buying his first home. We're very excited for Joe and his future as well. Steph Serafin and Krista Hunsicker are continuing their growth and are frequently collaborating with Cetera's study groups to share best practices with other firms nationally that are looking to replicate our growing team. On a personal level, Matt Kitchie from our office welcomed his third child. Larry Fiorini saw his daughter off to college, where she will be studying communications and continuing her lacrosse career. And my daughter became a teenager, uh, joined the honor roll, and has made the team for her school's soccer, basketball, and softball seasons. Now, last but certainly not least, at the beginning of the month, we also welcome Jim Mary to our advisor team. Jim is a graduate of Westchester University, holds his FINRA Series 6, 7, 63, and 65 licenses, as well as his Pennsylvania Life, Accident, and Health and Pennsylvania Property and Casualty insurance licenses. He is also a certified financial planner and a certified exit planning advisor. We're very excited to have him join the team, and I'm sure you will see him floating around the office next time you stop by. I think that's enough about us. I would now like to turn this over to our keynote speaker tonight, Gene Goldman, and he is going to take us through some great information about what we have in store for 2025. Without further ado, Gene, please take over.
Thank you, Dean. And you guys can see my screen. You guys can see me, right? Yes.
We can.
Okay, perfect. Awesome. Thank you. So thank you for the warm introduction. First of all, I'm actually in Philadelphia right now. I'm at the Philadelphia airport at the Marriott there. So I know it seems a little strange, but I'm here right now. So I apologize for the ambiance behind me. So Dean, thank you for the really warm introduction. So as Dean mentioned, I'm our Chief Investment Officer for Cetera Financial. I've been with Cetera now. Been in the industry for 31 years, a long time. And what we're going to do today is simply three things. Number one, I'll give you a quick recap of what the markets did last year. And I know we're not going to go into the details of like what exactly happened, but what I want to do is really focus on some really key tidbits that set the stage for where we're headed for in 2025. Number two, I'll talk about our three investment themes for 2025. And these are the key themes that we think will drive the markets and the economy for this year and the foreseeable future. And number three, I think most importantly, I'll weave in sort of our perspective of why we do see a potential pullback in the stock market, but more importantly, because we do believe when you have a year with modest economic growth, moderating inflation, double-digit earnings growth, and a Fed not raising rates, you historically have good but not great returns. So therefore, any pullback in the market, we continue to believe will be a good buying opportunity and should be pretty short-lived. So we'll do all this in about the next 4 to 4.5 hours. So be ready. I'm just kidding. We'll do this in the next half an hour or so or less. So three investment themes. So let me jump right in. So last year, 2024, and we had a very interesting year. And I could talk about the difference in terms of, international and US and whatever happened. But I think what's most important is to look at simply the S&P 500. And just so we're all on the same page, the S&P 500 is a broad stock market benchmark. It represents 500 companies for the US stock market. And what the index did last year is that it had its second year in a row where the stock market returned over 20%. What's so important about that is that we haven't seen something like that since 1998. So again, since 1998, this is the first time we've seen the stock market rally by 20% or more 2 straight years. We're also in a bull market, and a bull market is when stocks are just rallying. We've been in a bull market now since October of 2022. Also, if you look at the S&P 500, and we won't go too much into the dynamics of the index, but if you think about the index, the bigger the companies are a bigger portion of the index. And we'll spend some time maybe in the future to talk about why, but the larger companies contribute more towards the return of the index. So if instead we said, okay, let's take the 500 names and let's make them equal weight. So instead of saying the largest names contribute more towards returns, we'll say each stock represents the same exact weight. If you look at it that way, the S&P 500 returned about 11.1%. So again, it shows you that the Mag 7, those big, ginormous companies drove most of the returns last year. The Magnificent Seven, those big technology, those big artificial intelligence related companies, they drove about 63% of the return. Also, last year, we had 57 record closing highs. So if you take that as a numerator and you take the number of trading days last year, 22% of the time, the stock market set a record. That's unprecedented. And if you look here, that's just the 7th year since 1953 we've had the stock market return the stock market have over 50 record highs in the calendar year. And why do we care about 1953 as a side note? Well, that's when the stock market went from trading 6 days a week to 5 days a week. So just a little interesting tidbits. Also, last year, we did not see a correction. We did not have a correction in the stock market. And a correction is when stocks fall from top to bottom by 10% or more. And a correction is a normal part of investing. They occur about once every 12 to 13 months. We didn't have a correction last year. It's a very rare feat. We didn't have a correction. We'll talk about corrections later because we do envision a pullback, maybe a correction, but most importantly, please remember this, a correction is a normal part of investing. We have so many corrections, you just don't feel them because they're so commonplace. So that's that's what we did in 2024. So let's talk about our three key investment themes. So if you take a step back, last year we laid out our three themes for 2024, and they were simply this. Number one, the Fed goes from being a foe to a friend. The Fed goes from raising to cutting interest rates. And I'm going to spend a lot of time a little bit later talking about the Fed because everyone in my shoes says the Fed this, Fed that, Federal Reserve, all this other stuff. But I really want to talk about what the Fed does because it's so important because you're going to read a lot of information out there about what the Fed is doing. But let's get on the same page and let's make sure that we understand what the Fed is supposed to do. So last year, our first theme was the Fed goes from being a foe to a friend. They go from raising to cutting interest rates, and they did. Our second theme last year was simply this: no recession for 2024. We didn't have a recession. We saw some little uncertainty in a couple points in terms of the economy, but no recession. Good news, we don't expect a recession anytime soon. I'll come back to that a little bit later. And number three, our third theme last year was volatility would pick up. The stock market would have these big, massive swings up and down. We were a little wrong because the stock market really only saw some volatility last January. July, stocks fell from peak to trough by about 9.8%, and then a little bit in December. We didn't see much volatility. So if you give us a report card how we did last year, we're probably right in two and a half out of three. So let's pivot to this year. And these are the three themes that we believe will drive the economy and the markets for 2025. Number one, we simply call it the Great Moderation. Everything is moderating coming out of post-COVID, whether it's the economy, the labor market, inflation, stock market returns. Everything is moderating. It's slowing down. It's not going negative or drastically bad, but just slowing down and moderating. And it has important ramifications, especially when we talk about the Fed a little bit later. Our second theme goes along with the theme last year about the Fed becoming our friend. We believe the Fed becomes a friend, but not a good friend. So not good of a friend as you thought they were. What that means is that we don't expect the Fed to cut rates as much as they said they would last year. And I'll get into this a little bit later again, but that's our second theme. And then lastly, our third theme is diversification. Diversification is back. And that's the simple strategy of putting money in different parts of the market, a little bit in bonds, a little bit in stocks, a little bit in international. Diversification has not worked for the last couple of years because remember that slide I showed you before with the very narrow market, the Magnificent Seven? Diversification didn't work because the further you moved away from those big seven names, the worse you did. We think diversification is going to be an important strategy for 2025, and we'll talk a little bit about this later. So these are the three themes. Let me dive into each of these one at a time. Excuse me. So first of all, the economy is moderating. The economy is definitely slowing down. If you look at this chart, and as a side note, all my charts are organized in the same way. Horizontal axis, I'm showing time. Vertical axis, I'm showing a data point. So this shows US GDP, gross domestic product. This is the output of our economy, and this shows by quarter by quarter. If you look at the red arrow, since post-COVID, the economy is slowing down. Our US economy is definitely slowing down. It is moderating. It is slowing down. A better way to look at this is this next slide. This is called the City Economic Surprise Index. And it's an important index. What this index does is that it says every time a data point gets released, if it beats expectations, the line moves higher. If it misses expectations, the line moves lower. So again, beating expectations, a better than expected data point, the line moves higher. If it misses, the line moves lower. See on the right-hand side, the data is starting to come in a little bit less than expected. The economy is slowing down, it's moderating. And this is important a little bit later, especially when we talk about the Fed. But overall, the economy is slowing down, it's moderating, but we don't see a nasty, drastic sort of recession. So why are we even talking about a potential recession? So there was a CNBC study that came out maybe 3 months ago, and they asked viewers, they said, how many of you believe that there will be a recession? There's a recession right now. So a simple question. CNBC asked, how many of you believe that we are in a recession right now? 59% of us said that we are in a recession right now. And, think about that. It's concerning because a lot of people believe we're in a recession. We do believe parts of the income parts of our economy are struggling, especially lower income, especially given higher gas prices, higher food prices, higher egg prices, these inflation concerns. But overall, we don't see a recession anytime soon. So why is that the case? Well, remember when you and I, we all went to high school, we learned in Economics 101, we learned about a recession. And I remember my teacher up in Massachusetts, Dr. Winslow Smith, he said a recession is simply this. It's 2 quarters of negative GDP. So I thought about that. I learned that through high school, through college, through my career. But Dr. Winslow Smith was wrong. A recession is not 2 quarters of negative GDP. A recession is simply this. The NBER, the National Bureau of Economic Research, they're a think tank, and they dictate, are we in a recession or not? They look at 6 key factors. And it's hard to read here, I apologize, but these factors are like personal income, employment, industrial production. And see the red circle on the right-hand side? None of these factors are anywhere close to screaming recession. There is no recession coming anytime soon. Right now, we are in the 57th month of our economic expansion. The last expansion we had that got hit right when we went into COVID, that lasted for about 128 months. So overall, we are not headed to a recession, especially from the NBER standpoint. But with that said, though, what about us and our team? We can listen to the NBER, and NBER says no recession. What about my team and I? My team and I believe that we're not headed for a recession anytime soon. The first reason is simply this. Areas in recession right now are starting to get better. So parts of our economy are in recession. Let's face it, housing is because you have high mortgage rates, you have low inventory. Also, you look at manufacturing. Manufacturing is struggling. During COVID, we all bought tons and tons of stuff because we couldn't go to restaurants, we couldn't go to bars, so we just bought things. Like Dean, for example, bought 10 Peloton bikes, 10, they just bought and bought and bought tons of stuff. Coming out of COVID, though, we just stopped buying as much stuff. So what happened? Manufacturing slowed down dramatically. So the areas in recession are housing and manufacturing. But if you look at this chart here, this chart shows two of the most forward-looking indicators for housing and manufacturing: building permits and manufacturing new orders. Look at the blue line and the dark lines coming down. They both fell dramatically from 22 to 23. Makes sense because, again, both areas were in recession. Then they plateaued, they flattened out. And now see those red arrows? These areas in recession are starting to get better. So parts of our economy that are struggling are starting to improve. This is the good sign. This says to us that we potentially, maybe at worst case scenario, had a rolling recession where parts of our economy are hit. But long story short, things in recession today are moving out of recession right now. Um, with that said, though, I know the economy is doing well. I know the labor market, which we'll touch on in a second, is doing well. There's some underlying concerns that we're watching carefully. If you look here, for example, this is showing the number of corporate bankruptcy filings. So bankruptcy filings surged last year back to 2010 levels, and you see the red arrow, and you can see the chart pretty easily here. So what this says to us is that overall the economy is doing okay. It's moderating, but beneath the economy, there's some parts that are a little bit struggling, especially those areas reliant on lower interest rates. And with interest rates so high, they're struggling a little bit. And this is part of the reasons why the Fed needs to cut rates. Again, we will come back to the Fed in a little bit later. This next slide is probably the most important slide I will show you. This slide is the most complicated slide, but it's the most important. This is something your neighbors are not going to be talking about, but you need to know this. And I apologize, it's complicated. We'll spend a lot of time on this slide, but this slide is a crux of why we don't see a recession anytime, at least for the next 12 months. So what this slide plots, it plots what's called productivity. So productivity, a rise in productivity is simply this: the same number of people producing more stuff. That's a rise in productivity, whether it's technology, whether they're using AI, whether they're just being more productive. And you see on the right-hand side, that arrow that goes straight up, that's a surge in productivity. Why do we care? Because if you look at those little red circles, every time productivity has risen, we have exited out of a recession, and those gray bars are recessions. So again, one more time, every time productivity surges like that, those little red circles, every single time, every single time, we have exited out of a recession. That's so important to understand. So let me go over an example. It might be more easy to understand. So let's say that I'm here in Philadelphia, and let's say that obviously Philly won the Super Bowl. Let's say I'm a manufacturer in Philly, and I manufacture Philadelphia Super Bowl winning baseball caps, football caps. And so let's say that I manufacture these caps. So let's say all of a sudden we hit a recession. What happens? I go down to my factory floor as a small business owner. I go down to my factory floor and I say, listen, everyone, the economy is slowing down. We are hitting a recession. I have to lay some of you off. It's unfortunate. It's terrible. It's a really bad time. I have to lay some of you off. So I lay off some of my workers. Then as time progresses, what happens? We get some fiscal stimulus from the government. So the economy picks up a little bit. We get some monetary stimulus from the Fed. We'll come back to the Fed again. Fiscal stimulus, monetary stimulus, and things start to get a little bit better. People start calling me and they get very optimistic about the Eagles 2025 season, the Eagles 2026 season, and they start saying, Gene, we really want to buy your Eagles baseball caps because your Eagles caps are the best caps in Philadelphia. So all of a sudden they start calling me, they start asking for increasing orders of my caps. The problem is I'm a small business owner and I can't risk the fact that maybe the recession is not over. So what do? I go down to my factory floor and I say, listen, everyone, the economy is getting better, but as a small business owner, I can't hire more people. I need you to work longer. I need you to work longer hours. I need you to stay. I need you to use technology. I need you to be more productive. And that's the surge in productivity. So again, what this says to us is that no recession in the next 12 months, or more importantly, is that we probably already had a recession. We think we had a recession in March of 2023. We think we had a recession then, but the recession was so mild, we just didn't feel it. So again, this slide, productivity, watch this. You'll hear people talk about this. Productivity is extremely important. It's surging right now. This says to us no recession anytime soon. So the economy is moderating. Also, the labor market is moderating. So the labor market, and one way we can look at the job market is the unemployment rate. So the unemployment rate is the number of people unemployed divided by the total workforce population. And the unemployment rate went from 3.4% up to 4.3%. Now it's down to about 4%. Overall, the unemployment rate is starting, the job growth is starting to moderate a bit. And you can see it here. This is monthly job growth. So each month, the number of jobs created in our economy. And you see the red arrow, it is slowing down. It's moderating. The big question is, are we headed for like a big downturn in the labor market? The answer, in our opinion, is no. First of all, simply this: the unemployment rate is around 4%. That's a really good unemployment rate number. We are pretty close to maximum unemployment. Second of all, you look at this chart. This is one of my favorite ways to look at the labor market. And I'm a simple person. And I say simply this: how many jobs are out there divided by the number of people looking for jobs? So how many jobs divided by number of people looking for jobs? Right now, the ratio is 1.1. The 5-year average, you see the little red circle, is 1.28. So right now, there's 1.1 jobs out there for everyone that's looking for a job. Anyone that wants a job can find a job. Even those people, and you know who they are, that don't want jobs, they can still find jobs. There are so many jobs out there. Unemployment rate's 4%. Plenty of jobs, more jobs than people looking for jobs. Yes, there's some skills mismatch here and there, but let's face it, there are plenty of jobs out there. It's slowing down a bit. The other area that's moderating as part of this great moderation is inflation. Inflation is slowing down. So you look at this chart. This is called core PCE. This is the Fed's preferred measure of inflation. And there's many ways that you can look at inflation. The consumer price index, the producer price index, there's other variables we can look at. The Fed likes core PCE because it's a very diversified way of looking at inflation. It gets updated very frequently, and the Fed says we have a 2% target. If you look at this red arrow, inflation is definitely slowing down. You see the red arrow. So whether it's trailing 3 months, 6 months, 12 months, inflation is definitely slowing down. And the Fed has a 2% target. The concern here is that inflation is not falling fast enough. Here's another way of looking at inflation. Here's core core CPI. And core CPI, this is where you take consumer prices, you subtract out volatile food, volatile energy, and this shows you that inflation has come down and now it's starting to get a little sticky. And when I talk about the Fed a little bit later, this is important. Inflation is starting to be a little sticky. Overall, inflation is moderating compared to where it was just a few years ago, but it's getting sticky at the level it's at right now. Again, this is something as part of the great moderation. Stock market returns are also going to moderate, in our opinion. So, people in my shoes, we look at the stock market and we say, is it cheap? Is it expensive? And one very simple measure of understanding this is simply called the price earnings ratio, the PE ratio, the price of the stock market divided by the earnings of the stock market. And the higher that ratio is, the more expensive stocks are, the cheaper it is, the cheaper stocks are. You look at the right-hand side, 22, where it says 22.03. The PE ratio, the price earnings ratio of the stock market today is 22.03. Is that expensive? The answer is definitely it's expensive. The last 10 years, the average is 18.5, as you see the horizontal line here. The last 20 years, it's about 16. Stock market is expensive. It's very expensive. You can keep in mind, you can have a very expensive stock market, but you need low interest rates and you need low inflation. We have slowing inflation, we have slowing interest rates, but we don't have very low interest rates and low inflation. This says to us is that everything needs to be perfect. The stock market is saying everything needs to be very blissful, no mistakes, no policy errors, no geopolitical risk. Everything needs to be exactly perfect and just right. This is what concerns us. We'll talk about this in terms of market returns a little bit later. So long story short, we do expect, given the high valuations in the stock market, we do expect stock returns to moderate, to slow down a bit. So take all together, our first theme is simply this, the great moderation. Everything is moderating. It's not going bad. We're not seeing a recession. We're not seeing an implosion in the labor market. We're not seeing inflation go below the Fed's target. All we're saying is simply this, is that everything is moderating. So our second theme is basically simply this. The Fed is not as good of a friend as you thought they were. Basically, they're not going to cut rates as much as the markets anticipated. So let me kind of take a step back. Let's talk about the Fed for a second, because you always hear people on CNBC or Fox or wherever, Bloomberg, they say Fed this, Fed that, Fed this. Let's talk about what the Fed does, and more importantly, why do we care about the Fed? So the Fed is the Federal Reserve, and it's led by Jay Powell. Jay Powell is the chairman. And what the Fed does is that they decide interest rate policy. They do a bunch of other stuff out there, but they really decide interest rate policy. The Fed does so many different things, but primarily they have what's called a dual mandate. And the dual mandate is simply this. They want to, first of all, make sure we all have jobs. Number two, they want to make sure inflation is kept in check. So again, make sure we all have jobs and make sure inflation is kept in check. And what they do is they have a bunch of tools in their arsenal that kind of can control this, but their primary tool is called the Fed funds rate, and it's an interest rate. If, for example, there's the economy starts to slow down. Let's say that people start losing their jobs. People start, there's a recession. People start, there's just a lack of jobs fall. The economy goes down. Everything goes really bad. What the Fed does is they lower this Fed funds rate, this interest rate. And in theory, other interest rates follow and go down with it. And therefore, if the economy is slowing down and interest rates come down from the Fed, that means it becomes cheaper to borrow money to buy a car. Credit card rates get cheaper. Auto rates become cheaper. Home equity loan rates become cheaper. And when it becomes cheaper, in theory, it stimulates the economy. Because therefore, if it's cheaper to borrow money, if it's cheaper to use a credit card, you in theory are likely to buy more stuff. If you buy more stuff, this creates more economic activity and the economy gets better. On the other hand, as part of the dual mandate, if, for example, inflation is too high, because remember, their other part of the mandate is they want to keep inflation in check. Let's say inflation is too high, like it was coming out of COVID, and inflation surged. What the Fed does is that they raise that interest rate, that Fed funds rate. Then, in theory, home equity loan rates, credit card rates, auto loan rates, mortgage rates, in theory, they all move higher. And when they move higher, it becomes more expensive to borrow money to buy stuff. So this, in theory, slows down the economy, slows down demand for goods, and slows down inflation. So again, you're going to hear so much about the Fed, but always go back to the dual mandate. make sure we all have jobs, and make sure inflation is kept in check. Again, if we're losing jobs, they cut interest rates, they cut their Fed funds rate, interest rates fall down, stimulates the economy. If, on the other hand, inflation is too high, they do the exact opposite. So it's very, very important to remember that. So let's talk about the Fed. So the Fed, why do we think the Fed is our friend? First of all, we believe the Fed is not going to raise rates at all for this year. And I know there's some talk from people out there saying inflation is high, there's uncertainty around tariffs. We'll talk about tariffs a little bit later. Uncertainty, and maybe the Fed will actually raise rates. We don't think the Fed will raise rates. I mean, first of all, if you remember that slide I showed you with bankruptcies, the riskier parts of our economy are starting to struggle with higher rates. Also, if you think about that, remember that tool, the Fed funds rate, that interest rate the Fed uses? Historically, it trades about 0.5% to 1% above inflation. That's about 2% over inflation. It's a pretty high number. The Fed knows that the economy is fine right now, but there's some worries down the road that that Fed funds rate, that interest rate stays too high for too long. So if you look at this chart it shows the year-end probabilities of where the market thinks the Fed funds rate will be at year-end. So lot of bars here, but what it shows you is that there's an 85% chance the Fed will cut rates at least once this year, and there's a 50-50 chance they'll cut rates at least twice. On the far right-hand side, there's a 15% chance they won't cut rates at all. Regardless of what happens, we do believe the Fed is not going to raise rates because the economy is just right. It's moderating just right, and raising rates despite the uncertainty about inflation, which I'll talk about in a second. It doesn't make sense for the Fed to raise rates at all at this point. But now the question is, why are they less of a friend than we thought they were? And again, the point is that they're going to cut rates less than was anticipated by the markets, less than was anticipated by the Fed last year. So if you look at this chart is called the implied Fed funds rate. And this is basically looking at a bunch of financial data to say, okay, based on these data, based on these futures markets, what will the Fed funds rate, remember that lever, be at the end of this year? So right now, that Fed funds rate is at 4 3/8. Right here, the Fed, the horizontal lines, in December of last year, the Fed said, we expect to cut rates twice, bring it down to 3 7/8. Then if you look at the information that they said back in September, they said the Fed said they would cut rates 4 times down to 3 3/8. What you're seeing here is that little ziggy-zaggy line. That's the market saying, okay, Fed, we thought maybe at the end of this year you would be at 2.75, but now we don't believe you. And we actually don't believe you what you're saying. And what this line is showing you is that the market is saying, Fed, normally we follow you. In this case, we want you to follow us. And this is a little uncertainty. This is basically the markets leading the Fed saying, Fed, we don't believe you that you are not going to cut rates as much as you say you will. You are not going to be a friend as much as you said you would be. Another way to look at this, again, what's driving this is bond yields. So if you look at this chart, and this chart shows the 10-year Treasury yield, and in theory, if there's more inflation or more economic growth in our economy, the bond yields move higher. There's other factors, but let's just assume that. If there's more inflation, more economic growth, the line moves higher. When the Fed first cut rates by 0.5% back on September 18th, which we think was a mistake, they should have only cut by 1/4, but we can spend another time talking about that. The Fed was too aggressive, and they were worried about what they thought was a weakening job market in June and July. But it wasn't weaker. We just had a couple storms. We had some storms, we had some bad weather, and so a lot of people couldn't get to work, couldn't be hired. So the Fed freaked out and they said, we're going to cut rates too aggressively. Because of this, you've seen inflation pick up. You remember that I showed you that chart on inflation being a little bit more sticky, and economic growth is starting to pick up. And you can see all this taken together. 10-year Treasury yield. This is sort of the bond yields of our government have moved up dramatically on higher growth and higher inflation expectations. Then, if you think about inflation expectations, there's a survey that comes out once a month called the University of Michigan Survey of Consumer Expectations. 2 months ago, this line was at 2.8%. Then last month it was at 3.3. And this chart, I couldn't get it updated in time. I apologize for this. But now this is at 4.4%. We haven't seen this number since back in since over a year ago. This is the market. This is you and I, consumers saying, oh my God, inflation is picking up. And remember, going back to the Fed's dual mandate, when inflation is picking up, they want to keep inflation in check. They can't cut rates as much as they hope. Will they raise rates? We don't see it. We don't see them raising rates because, again, the uncertainty about the riskier parts of our economy. But overall, this is saying there is more inflation coming into the market. This is putting pressure on the Fed to say we can't cut rates as much as we want. So, long story short, the second theme is simply this: the Fed is a friend. The Fed's not raising rates, but they're not likely going to cut rates as much as was anticipated last year or by the Fed themselves. So again, number one, great moderation. Everything is slowing down. Number two, the Fed is not a good friend as we thought they were. Number three is diversification is back. And diversification is a strategy to help you mitigate uncertainty around the Fed, uncertainty around moderating market returns. So remember, as I said at the onset, we do think this year is going to be a good but not great year for the stock market. So historically, when you have modest inflation, modest economic growth, moderating inflation, double-digit earnings growth, and you have the Fed not raising rates, historically, we've seen the stock market return good but not great years. And we do believe we'll still get that. But the problem is that we likely are going to see a pullback near term. And again, any pullback, and I'll show you some examples in a second, any pullback, in our opinion, remains a buying opportunity. We've been saying this for the last 2 years. Any pullback, any sell-off in the market is a huge buying opportunity. So the question is, why do we think stocks are going to be weak near term? And there's a few reasons. Number one, uncertainty around the Fed. We talked about that already. Number two, sticky inflation, putting upward pressure on in bond yields. Remember, bond yields move higher. It also becomes more expensive to borrow money because we'll go into it in another presentation in the future, but higher bond yields, like the 10-year Treasury yield, mortgage rates are based on that. So if the 10-year Treasury yield, borrowing rates move higher, mortgage rates move higher. So uncertainty around the Fed, higher potential inflation, higher bond yields. And the third reason why we do see a pullback near term is just these weird market dynamics. And I know weird sounds kind of like a weird thing to say, but the markets are acting extremely strange right now. And let me show you what I mean by that. So first of all, if you look at this chart, remember the S&P 500, that broad stock market, the 500 companies, since October 27th of 2023, stocks have gone straight up. See that little red arrow? They've gone up nearly 48, nearly 50% nonstop. We have not had a correction in that almost the entire time period. And remember, corrections happen about once every 12 to 13 months. And I'll come back to that a little bit later. We've had no correction. We've had nothing. Stocks have gone straight up. Good news, bad news, whatever it is. Geopolitical risks, increasing inflation, decreasing, whatever you want to say. Stock markets have ignored that. They've gone nearly straight up. This worries us because this has pushed up valuations. Remember, the PE ratio, price earnings ratio, is extremely high. Stocks are expensive right now. Another thing to look at is there's too much optimism in the market right now. So this may sound counterintuitive, but when there's too much optimism in the market, it's a contrarian indicator. That means that if everyone is feeling good about something, the stock market views it as a contrarian indicator. That means it's a bad sign. So if you look at this chart shows you that from the consumer confidence and the survey, one of the questions is simply this: do you expect stocks to rise in the next 12 months? Nearly 60% of people believe stocks are going to rise. Everyone believes this. So 60% of you and I, a record high, believe that stocks are going to be higher. Even my mom, who does not buy stocks, she's calling me saying every other day, hey, Gene, we should buy stocks. We should buy stocks. When everyone is bullish out there, it's a contrarian, it's a concerning indicator. And we're seeing everyone being super excited about the stock market. This is worrisome for the market. Also, if you look at this chart, it's another way of showing you what I just showed you, but this is from our friends at the Fed. And the Fed, they're monitoring bullishness in the market. And this shows you that this is the percentage of financial assets that are in equities. So again, the percentage of financial assets in equities. Right now, there are 43.4% of financial assets in equities right now. This is a record high. Look at this chart. This chart goes back to the 1950s. We've never seen so many people being optimistic and bullish about stocks. Remember, when everyone's thinking one thing, the stock market gets a little worried because you've got to have people out there selling too. If everyone's buying, it's a bad sign. It's a concerning sign. Another thing to look at in terms of the weirdness of the market is that we're very, very concentrated. So remember I told you at the beginning that the S&P 500 has 500 companies in the index, 500 companies. The top 10 names, just the top 10 names, represent about 38% of the index. The other 490 names represent 62% of the index. So the top 10 names, 38%. The other 490 companies, only 68%. It's a very top heavy index. And this is what worries us. One mistake, one earnings miss, one slowdown, one of these companies can have a big effect on the stock market. So, you think about, and I can't talk about individual companies, but you think about all these companies spending money on artificial intelligence, and then you have a competitor come out from China called DeepSeek, where they come out with another large language model that, in theory, could compete with OpenAI. In theory, could compete with it, create at a much cheaper price. And so again, I know there's discussions about, it's a Chinese company, did they fake it, whatever it is. Regardless, I mean, you have another potential competitor that says to US companies, I know you spent a lot of money on AI, and maybe you aren't going to get as much return as you thought you would, because now this other way of creating these large language models is available. So again, this adds more uncertainty, especially among these big Magnificent Seven stocks. Also, another concern about the market, the dollar is rallying. You look at this chart on the far right-hand side, the dollar is surging. The dollar is up about 8% in the last few months. Why do we care? Because a dollar that's rising is more expensive for our US companies to sell stuff outside the US. Right now, remember the S&P 500? 40% of revenues come from outside the US. The dollar gets stronger and stronger. All of a sudden, their goods become much more expensive to sell. That's not a good sign. I know, I'll come back to President Trump and the administration, but President Trump is trying to weaken the dollar. He wants a weaker dollar because if the dollar is weaker, it becomes cheaper for us to sell stuff outside the US. But he's going to have a hard time. We are at record levels of oil production. We are at record levels of commodity production. We are seeing about 27% of our treasuries being bought by foreign investors. To buy our oil, to buy our commodities, to buy our treasuries, you need dollars. This is putting upward demand on dollars. I don't see the dollar weakening anytime soon. Again, this is a concern for the markets. So, speaking of President Trump and the administration, another uncertain part of the market, and oh, let me take a step back, please. I'm going to talk about Trump. I'm going to talk about the Democrats, Republicans. I am not a political person. I'm independent. My job is to understand the ramifications of whoever's in office, understand the ramifications of Congress, of the effect on our economy. So again, I'm not a Republican. I'm not a Democrat. So please don't go, tell Dean, I can't believe Gene is a closet Republican. I can't believe Gene is a closet Democrat. I'm not. So please keep that in mind. So one thing about the Trump administration, there's excitement about corporate taxes being cut. I'm very skeptical of that, because if you look at this chart simply shows from the Congressional Budget Office, this is a nonpartisan group that shows you in the dark lines the federal budget deficit as a percentage of GDP, and the light blue lines are the projections. We are at very heavy debt levels right now. So for President Trump to cut, say, corporate tax rates, for example, this is what the market is potentially excited about. It's going to be very hard because, first of all, we have a lot of debt. So if you try to cut corporate taxes, you need to get more revenues, but our debt is so high, you won't see the economic kick from cutting corporate taxes. The other perspective is that if you look at our corporate tax rates relative to the other G7 nations, we're pretty comparable. So there's not much more wiggle room to cut from a corporate tax standpoint. The other thing to think about is adds uncertainty. I think it's overblown, but it adds uncertainty in our market, are tariffs. And you've heard, obviously, tariffs. We raise prices, we punish those countries that are doing unfair trade practices. My perspective and my team's perspective is that we believe the tariff issue, while it will create market volatility, so that's why I have it here, it's going to be pretty short-lived. And there are three reasons why. Number one, if you listen to President Trump, he talks about retaliatory tariffs, not universal tariff. The big fear was, especially during the campaign, during his speech in Davos to World Economic Forum, he talked about the importance of a universal tariff punishing every country out there. That freaked out the markets. But if you listen to his rhetoric, his comments lately, he's talked about retaliatory tariffs. That's a country by country basis. That's good news, because then it allows each country more time to negotiate. Again, whether you believe President Trump is a negotiator or not, whatever people talk about, it gives more opportunity to say that at least country by country, it can be negotiated, not a universal tariff, which is being raised on every country. Retaliatory tariffs are better. Number two is the fact that exports to the United States are much bigger of a percentage of GDP than they are to us. So if you look, for example, than our exports to other countries. So if you look, for example, look at Canada and Mexico. Canada and Mexico, 20% of their GDP represents exports to the United States. So you can see the importance. That's why when President Trump initiated tariff or threatened tariffs in China and Mexico, I mean, sorry, Canada and Mexico, for example, that's why they came to the negotiation table almost quickly, because we represent over 20% of their economic growth in terms of exports to our country. That's good news there. That again, that gives us a better, I guess, better part of the bargaining table. And the third thing that you could look at is, even if tariffs are enacted, it tends to be pretty short-lived. Let's look at 2018, for example, when President Trump initiated a ton of tariffs on countries. The stock market fell from peak to trough by about 16%. That's a correction. That's a big fall. But remember, corrections happen once every 12 or 13 months. But stocks fell 16% from peak to trough. But and this is 2018. But remember, we were back to pre-tariff market returns by May of 2019. So even if stocks do pull back, even if they do sell off, we do think it's going to be pretty short-lived. So overall, we're optimistic on the whole tariff front that it's going to be short-lived. The U.S. has a better bargaining position, and these tariffs are retaliatory, not universal. And one more thing about President Trump and the presidential cycle. This chart is something that we tweeted recently, is that regardless of whoever's in government, whether it's a Republican, whether it's a Democrat, incumbent, challenger, the stock market tends to do okay in the first year of a presidential cycle. So you look on the right-hand side, since 1949, the first year of a presidential cycle, the stock market returns about 11.6%. Again, this is all history, and you can look at history and say, take it with a grain of salt. But regardless, the excitement of a new person in office tends to add some more excitement to the stock market. So again, regardless of what happens, stock market tends to do okay in the first year of a presidential cycle. So as I said before, we do expect near-term pullback, maybe a correction. But why do we think it's short-lived? Why would we view it as a buying opportunity? And there's two key reasons. Number one is that there's a ton of cash on the sideline. If you look at this chart, there's $24 trillion of cash, of money market assets sitting on the sideline waiting to get in for better valuations. We saw this in July of last year. We saw this in December. We saw this earlier in 2024. As soon as stocks pull back, there's a lot of buying power, a lot of dry power jumping in, looking for better valuations. Lots of money on the sideline waiting for a better valuation. This is a sign of any pullback will be short-lived. And again, our perspective is that we expect a good but not great year. If stocks pull back, good opportunity to get in for a better opportunity. The other reason why we think any pullback is short-lived is that we are in a really good earnings season. If you think about, there's the old adage, earnings drive stock prices. And what this means is that companies that generate strong earnings, investors tend to buy the shares of those companies. If you look at the red circle here, if you look at the S&P 500, remember the 500 names, earnings are expected to rise about 14.7% this year. This is according to FactSet, according to analyst estimates. Generally, the stock market prices in earnings strength about 3 to 6 months in advance. There comes a point, if stocks pull back, that investors will start to price in, oh, these are good opportunities because earnings look pretty good. So again, cash on the sideline, really strong earnings growth says to us that any pullback is a short-term pullback, maybe a correction, but it's a buying opportunity. And then lastly, let me as I kind of wind down, let me show you this slide. This slide is important, but this slide, it's complicated, but this slide is so very, very important. So if you look at this slide, those bars at the top all represent performance of the S&P 500. And if the bar goes up, that means the stock market had a positive return that year. If the bar goes down, the stock market had a negative return. If you look at those red squares, those are the average intra-year pullbacks, corrections, sell-offs, downside, whatever you want to call it, for that specific year. What this shows you overall, it shows you in the last 45 years, since 1980, the stock market has been positive in 37 of the last 45 years. The stock market has an upward bias, and it makes sense because our economy is growing, Earnings are growing. Our country is doing well. The stock market has a positive bias. But despite being positive in 37 of the last 45 years, the average intra-year loss, the average sellout, the average decline, the average pullback in any given year is negative 14.1%. So these pullbacks, these corrections are a normal part of investing. These are buying opportunities. Our perspective is simply this. You need to be diversified. You need to have diversification to mitigate some of those downsides, to mitigate some of that uncertainty, because the stock market over the long term has a long-term upward bias. So, as I said before, we have three themes. We have three themes. First of all is the great moderation. Everything is slowing down, but not going bad. Number two is that the Fed is a friend, but not as good of a friend as you thought they were. And number three is that diversification is the best strategy for, not the, I can't say best, sorry, scratch that. It's an important investment strategy for you. So what do you do? What do you do with all this information? Two things. Number one, be diversified. And diversification is simply this: exposure to different parts of the market. You don't want to be too risky, nor do you want to be too conservative. So you need exposure to the market, into bonds, and international based on your long-term objective. The second thing to do is you want to make sure you're not too aggressive or not too conservative to your long-term objective. So again, don't be too aggressive, don't be too conservative relative to your objective. How do you do this? Stay in touch with the investment team here. Stay in touch with Dean and his advisors. Be in touch with them. If there's anything changing about your life, anything changing about, another child, a child going to college, anything changing, they need to be aware of this. You need to be on the phone with them. You need to go in the office and talk to them, because they need to make sure your portfolio is not too aggressive or not too conservative. And that's so important. Yes, diversification helps to smooth out those uncertainties, but you also don't want to be too aggressive or too conservative. So if you see here, you can follow my investment team, it's Cetera Investment Management. You can follow us on Twitter. I know that Dean is still trying to get us on MySpace and Friendster. We'll get on there one time, but we're still working on that. And then you can follow me, Gene Goldman, on Twitter. And one thing, I have a favor to ask. Every year, my mom, I go home for Christmas. I see my mom, and I live in California. She still lives about an hour outside Boston, and my mom always shows me her phone. She goes, "Gene, look, I have more Twitter followers than you do." So that's my New Year's resolution, is to get more Twitter followers than my mom. It's hard to compete with my mom, because my mom, she tweets about, she's a Patriots fan, so please don't hold that against us. She tweets about Patriots scores. She tweets about dogs that need to be rescued, which I think is very important. And she tweets some weird political stuff you don't want to see. But please follow us on Twitter if you can. Before we go to Q&A, let me just show you some disclosures. I will not read these disclosures to you, but please read them on your own. These are very important for you to see. And let me go back to thank you. And with that, I'm going to stop sharing my screen so I can be a little bit bigger on the screen.
Wonderful. Thank you so much, Gene. That was a lot of information.
Okay.
We appreciate you joining us tonight. I think at this stage, we'd like to open up the opportunity for you to ask any glaring questions that are on the top of your mind. This is a unique opportunity where you have Gene available to answer any specific questions you might have. So please don't be shy if you're thinking something, or thinking about something rather. Chances are somebody else is thinking the same thing. So
And I apologize if my
please,
camera went
please
off.
take an opportunity to
Sorry.
raise your hand, and we can unmute you and go ahead and ask your question. So
Jim Marr?
He's
You can go ahead
muted.
and unmute yourself.
Okay. How you doing? Thanks, Gene. That was really good. I appreciate that.
Thank
Please, my condolences to your mom for the 5-year drought that the Patriots haven't won. I mean, it must be horrible after all those championships being spoiled like that.
She's all about draft picks. It's fine.
The one thing I wanted to talk to you about was, you had mentioned the dollar, being so strong, and a lot of our clients are always asking about international exposure. How do you think that's going to affect the exposure to the international stock markets?
Sure. It's a great question. It's a great question. So first of all, looking on the U.S. side, as I mentioned before, a strength in the dollar, our stuff becomes more expensive. And so when you do currency translation back, they don't get as much revenues. The other aspect, a stronger dollar, and this is what happened back in 1998 with long-term capital. Back in the day, what happened, the dollar surged because we had this uncertainty about the Russian ruble currencies back then. The dollar surged. What happened? A lot of emerging market nations struggled because emerging market nations and also some other developed nations, they borrow in dollars. They borrow from the U.S. in dollars, but their revenues are in local currency. So what happens is here are your costs in dollars, here are your local revenues. If the dollar strengthens, your debt starts to rise dramatically, and you're still getting lower revenues. This is why you saw a lot of companies back in 1998 implode and do really poorly. That's called the long-term capital drove all this. What we do believe, yes, the dollar is stronger, but we do think a lot of the bad news in the dollar is already priced in. You look at the U.S. stock market. The U.S. stock market has a 22 times forward earnings from a valuation standpoint. You look at nations like the emerging market nations. You're seeing valuations at about 12 or 10 times forward earnings. So yes, there could be some volatility. There could be a little sell-off. There could be some weakness, but there's not that much weakness because a lot of the bad news is already priced in. Plus, if you look at a U.S. population right now, our average age is 39. If you look at India, it's 24. If you look at Indonesia, it's 27. That's where you're seeing growth. So, whereas you have some exposure to emerging markets, but we try to focus on sort of the growing middle classes and these economies, also maybe looking at infrastructure build out. Then if you look at the developed nations like say Germany and France, this year France and Germany are outperforming the US because a lot of the bad news is already factored in. There's optimism that maybe Russia-Ukraine war will end soon. Again, we'll see what happens there. Also, we're leaving the winter, and now leaving the winter, the worst part for Europe because of natural gas prices. So there's opportunities there. So Europe especially. So regardless, international is pretty sharp. Oh, plus the European nations are cutting interest rates at a faster rate than we are in the US. That's good news too. So optimism there.
Thanks,
So
Ryan.
thank you for the question.
I don't see anyone else raising their hand directly.
Should we talk about Freddie Mitchell? I'm just kidding.
I think one thing that I would like to highlight, not necessarily more of a question, is you preach diversification.
Yep.
And diversification is really just bucketing and having enough in certain areas to where you don't necessarily need to pull from that asset class in the event that there is a downturn in that asset class. When you look back at historical markets and specifically over the last 10 years, obviously with the growth we've seen in the S&P 500, the bias now is to become less diversified. So to hear you say that now is a time to not abandon that strategy, I mean, I think there are a lot of people that are saying that we don't want to be in anything other than the S&P because we've gotten burned over the last 10 years by being diversified. So to hear you mention that we think that international might be a strong play still, and that diversification is strong, that's kind of reassuring for the way that our portfolios are managed with a little piece into each of the different asset classes, cash inclusive of that. The bond yields obviously going up. That's a good thing for fixed income investors. So
I totally agree. Even small caps too and mid caps. If you think historically, when the Fed stops raising rates as they did September of last year, historically market breadth widens. So it's just a fancy term for other parts of the market start to catch up with what's done well. So like value stocks, like those boring value, those boring quality names, those boring small caps, they tend to catch up. They tend to do well when the Fed stops raising rates.
Larry, do you have any points that you'd like to bring up?
Yeah, I have two questions. Gene, the Magnificent Seven, they're the big drivers of the insane. Because if you looked at like Procter and Gamble and Merck, if you look at the traditional value stock, those PE ratios are not out of hand. It's the it's the tech AI driven stocks.
That's correct.
Is their historical PE ratios significantly higher than it was say 10 years ago, 5 years ago? Because those seven drive it. what was the PE? What's the PE ratio of the Magnificent Seven now versus 5 years ago, 10 years ago?
Sure. So I think you could look, the last I looked at the PE ratio, again, price earnings ratio, higher, it's more expensive.
Yeah, yeah.
Right. It's, I think on the Magnificent Seven, it's around 38 or so. Last time I checked. Let's say 40.
Say
Historically,
40. It
those
doesn't matter. Round
yeah,
numbers.
say 40, let's say 40. That's pretty high. If you look at those other types of companies, like value companies, small cap companies, their PE ratios are around 17 or 18, and and their long-term average is maybe like 15 or so. So
Right.
they moved up because people are buying banks, are buying consumer companies. I love Pringles. I'm buying, from the companies that makes Pringles. I can't talk about individual companies, but you get my point. But you're seeing people buy the companies, but again, everyone's like, "Oh, I gotta buy the Magnificent Seven. I gotta buy those companies." Yeah, they could do okay. Artificial intelligence is the wave of the future. It's definitely the wave of the future. It's like electricity back in the 1890s. It's going to be so huge. We don't know how big it's going to be, but the problem is that if you go back to the tech bubble back in 99 and 2000, internet was definitely the future, but you don't know who's going to survive, and you have these other competing measures. Remember, back in the tech bubble, we went from business to business to consumer, and business to consumer did a lot better. That where with streaming now, where all that stuff.
Right.
So,
Right.
but AI is going to be huge. So,
Another question. The 10-year in my, I don't know, 30 plus years I've been doing it. I don't know that I've seen a more volatile year in the 10-year treasury than we saw in 24, with just 10 years down 3.5, 3. They're saying it's almost up at 5, and it's back at 4. It's do you think that is going to moderate also? And I don't know if you forecast fixed income returns, but do you believe 25, 26 will be, years to not have to worry about your bond portfolio? And, a lot of it's directly correlated to the 10-year volatility, movement of the 10-year.
Yeah, it's so everyone keep in mind the 10-year treasury is a proxy for the entire treasury market, but there's also there's a 6 month, there's a 2 year, and so on. First of all, as a side note, the 2 year. Remember I talked about the Fed funds rate, that lever? The 2 year is important to watch because the 2 year is what the market is saying where the Fed funds rate will be 1 year from now. So everyone watches the 2 year and we watch the 10 year. So Larry, to your question about the 10 year. The 10 year right now is around 4.57%. So that's if you're an investor, you borrow from the government borrows from you for 10 years and they pay you 4.57% in theory every year until 10 years and they give you back your principal. So right now, as you said, the 10 years gone all over the place. We do think we're closer to the top than we are to the bottom for a few reasons. First of all, 10-year treasury now trades at about 2% over inflation. That's a very high number. So that means you're getting about 2% real return. That just means 2% over inflation. You're getting a positive real return. That's a huge opportunity. I think second of all, a lot of foreign investors buying treasury. That's a demand. Third of all, we only had 1 negative week. We only had 1 week last year of bond fund outflows. So you and I, my mom, our friends are buying bonds every week. And there's that strong demand. And the other thing to think about is that historically, if you look at the 10-year treasury yield, it tends to peak at around the year over year. I'm going to get into the economic mumbo jumbo. I apologize, but it tends to trade at about where the US year-over-year US GDP nominal rate is. So the growth of our economy, not the real return, but the nominal rate. So year-over-year, the nominal rate is around 5.07%. That's where it tends to peak at. And right now we're at 4.57. So I apologize, my camera's a little bit funky right now. So basically, long story short, we think there's huge buying opportunities in treasuries. Yes, there'll be some volatility. Yes, there'll be some uncertainty, but you're getting some really positive things in the treasury market. I'm just going to reset my camera.
Do you prefer extending the duration of treasuries right now versus?
Yes, we have in our portfolios. We think it's a good buying opportunity to extend duration. And duration, for those of you listening in, duration is interest rate sensitivity. So a higher duration means, long story short, when bond yields move higher, prices move down. To determine what that price is, a decline in the rise in yield, is called duration. So if a bond has a duration of 10, if the price moves up 1%, bond yield falls by 10%. Yeah, so basically. So it's interest rate sensitivity. So we do believe increasing interest rate sensitivity because we do believe we're closer to the top than we are to the bottom for yields.
Great. That was it. Thank you.
Thanks, Larry. Thanks for the questions.
Well, we're coming up on the hour here, so if there are no further questions, I think one of the main points that I really would like for everyone to take from today's conversation is one of Gene's key points. The need for diversification in this market is important and paramount. You need to make sure you have access to certain asset classes that are going to be free from volatility. It's important to have some bonds in the portfolio, important to have a number of different asset classes in your portfolio that are unique to your specific goals and your specific time horizon. My portfolio is going to be vastly different than someone nearing retirement, and that's okay, as long as it meets your long-term goals. So with all that being said, Gene, again, I'd like to thank you for your time this evening. This is wonderful, great event. And I'd like to thank each and every one of you for joining us tonight. Please take full advantage of following up with your specific advisor in regards to any questions you have and follow up to tonight's event. If there's anything at all that we can be doing for you, please let us know. As always, we will keep you abreast of any large scale allocation changes that we recommend for your specific portfolio. But if there's nothing further from anyone, I wish you all a great night. Thank you again, Gene, and have a great day. See you guys.
Thanks, everyone.